And thank you, traders, for showing up. I always look forward to presenting and to hearing your questions, your comments, and I'm also going to be looking at any trades that you're interested in. So let's get going. So again, as Renee said, I'm Dean Jenkins, founder of followmetrades.com, and I'm going to be presenting what I call East meets West, how I combine Ichimoku Cloud with Elliott Wave. And I know Vince just presented an approach to Ichimoku Cloud. And there's a lot of different ways to trade the market. So I enjoyed Vince's presentation, learned a few things, and maybe you'll learn something from mine and just pick up another tip or two. Again, there's many, many ways to do this. So we'll just go ahead and jump in, and please fire off your questions as we go. I love making it interactive and just fielding your questions and your comments as we roll through the presentation. Got plenty of time. So quick disclaimer as always, you know, I'm a trader. I'm not a financial advisor. I'm not giving financial advice. There's risk in trading. I'm going to show you some of my favorite trades during this presentation, trades that I'm in, ones that I think are good ideas. Whether you take a trade or not, of course, that's your decision, and you assume the risk for that. So here's what I'm going to do. I'm going to talk about some of the tools that I use in my trading. I'm going to talk a little bit about Dow Theory, a very simple portion of Dow Theory, a quick overview of Ichimoku Cloud and how I approach it, and then Elliott Wave, very simple, repeatable version of Elliott Wave. I'm going to talk about how I combine them into a way that I think is pretty powerful. Now I'm going to share a couple of my favorite trades right now that we're in, that they still got good entries, and I'd be happy to look at any stock charts or any instrument you like. I'm primarily a stock and option trader, but you know, technical analysis works on any instrument. So that's the agenda. Here we go. So I use three key tools in my analysis and in my trading: Dow Theory, like I said, Elliott Wave, Ichimoku Cloud. So Dow Theory. Charles Dow developed his theories back at the beginning of the previous century. So we're over 100 years since Charles Dow created his theory. You know, the Dow Industrials is named after him, of course. And you know, his theory is pretty involved, and there's a lot of other information and sector rotation and all kinds of kind of stuff like that. But this simple portion of his theory that I use in my trading, and it still works today, it's really just about trend analysis. And it's how do you know that a trend is continuing, and how do you know when a trend has changed? That's important to know as traders, right? Are we still in a trend? Has it ended? Has it changed? So what Dow tells us is in a bull trend, it's continuing. You have a bull trend as long as it continues to put in higher highs and higher lows. And as long as these lows don't go below the previous lows and goes on to make new highs, you still got an uptrend. So that's a nice working definition. It's really easy. Same thing for a downtrend. Downtrend is defined by a series of lower lows, lower highs, lower lows, lower highs. And as long as you're putting in new lows, not taking out previous highs, you're in a downtrend, a bearish trend. So that's really important. And it's also helpful to know, when does a trend begin? And so there's 3 data points that prove that a trend has begun. It takes a high, higher low, new high. When you get that new high, one tick above, pretty good probability that you've begun a bull trend, either coming out of a channel, you know, a market going sideways within a defined range, or after a downtrend and it's turning back up, it's correcting or starting a new trend in a new direction. So how do you know when it ends? When you don't put in a new high, you have a lower high, and then you take out a previous low, you got a new low. So again, wouldn't you want to know, if you're in a trade, a long trade, wouldn't you want to know if the uptrend has ended, when it's time to get out? I actually use these for stop placement and trade management quite a bit. I'll show you some examples of that. So bear trend, again, 3 data points to prove that it begins. You got a low, lower high, new low. You get that 3rd data point, pretty good chance the trend has begun. And the trend continues with lower lows, lower highs, lower lows, lower highs, till it ends. Higher low, new high. Oop, trend over. Okay, not always. There's some anomalies. There's no free lunch on Wall Street, and there's no certainty. There's probability. So when you get these patterns, there's a pretty good probability of trend beginning, trend ending, trend changing. All right, again, please fire off questions as we go. I love to make it interactive and to know you're with me. So Ichimoku Cloud, developed by this handsome gentleman, Goichi Hisada. He started working on this back in the 1930s in Japan. He was a financial reporter. Unlike most indicator developers, he wasn't a mathematician or so much a trader, but a financial reporter, a journalist. So he started working on it in the 30s. He spent about 30 years getting it together, proving it, and he finally published a book in 1969. And Ichimoku Cloud is the Ichimoku Kinko Hyo, translates into one look equilibrium chart. So that's a little bit of history. Here's what it looks like. I use TradeStation primarily as my trading platform, and here's what Ichimoku Cloud looks like displayed on TradeStation. I've changed the colors. The standard presentation, I think they have some cyan and purple or something like that. I like red and green, right? I understand red and green, right? Red's down, green's up. And then I've colored a couple of the components here, and I'll walk through some of these components of the Ichimoku Cloud. If you're familiar with the cloud, you'll notice that I'm missing one of the components, and that's the Chiku line. I don't use it. In my approach, I don't need it. It just clutters up my chart, and try to keep the charts as clean as possible. So let's walk through some of the elements here. Of Ichimoku Cloud. Hey, I see your question, Amit. NOCIL, one Indian company using Ichimoku. I have not heard of that, so I can't help you with that, Amit. Sorry. Okay, Ichimoku Cloud, 5 elements that I use. First one is the Tenkan line. It's this, I've bolded it here. It's this yellow bold line I'm pointing to. That's a fast line. It's called the conversion line. Very similar to a simple moving average line. A simple moving average is calculated by taking the average of the closing prices in a fixed number of look-back bars. The Ichimoku Cloud Tenkan takes the highest high, highest low average. So a little bit different calculation. And I think I like it better. It gives you better a midpoint, because in an uptrend, right, the closing price is going to be biased to the top of the bars, and in a downtrend, the closing price is biased to the bottom of the bars. But if you're taking the average highest high, highest low, you really have a good midpoint for the look-back period. So Tenkan line is a fast line, very similar again to a simple moving average. And crossovers, what we're looking for is crossovers. And so when it crosses over the slow, which is called the Kaijun line, right, that can indicate a change in trend. So the Kaijun, or baseline, is the same formula, highest high, highest low, divided by 2, the average, looking back over a greater number of periods. So just like with a 2-line simple moving average, where you have a short period, long period, with Tenkan Kaijun, you have a short period, a long period, and you're looking for crossovers of those, indicating potential trend change. Okay. So again, they can indicate trend change, but by themselves, not really sufficient. So that takes us to the other element here in Ichimoku Cloud. And the first part of this is the span A, which is this green line. It's defining the shaded boundary, and that's called span A. It means going first. Okay. Formula for that is the fast line plus the baseline divided by 2. So it's the average of these 2 lines, the Tenkan and Kaijun. Okay, and that's the leading edge of the cloud. And then the next element is the span B, which is the slower part of the cloud boundary. And that takes the highest high and the highest low over a period longer than the look back period. Okay, and then there's the cloud with the Kumo. This is the space between span A and span B. It's a shaded region. And you can see what's really cool here is that it's projected several bars out into the future. So it's a predictive indicator rather than a purely lagging indicator. It's being calculated based on historic data, like all indicators, but it's predicting a support or resistance area. And the thicker the cloud, the greater the predicted support or resistance. And a question from KR, does this work on 1 3-minute tick charts? Yeah, absolutely. Any chart that can plot an open, high, low, close bar, candlestick or regular bar, can generate these indicators, absolutely. You know, if you take away the time scale, you have no idea. They all look the same, right? They're fractal in nature. So what's really cool is when you get a crossover of the Tenkan over the Kaijun and it breaks the cloud, it gets pretty predictive of new trends forming. Now there are some false calls. So we use some additional data to prove that. That's where Dow Theory and Elliott Wave come in for me. Okay, but once it does predict it, like you say, wow. Once we get a new trend forming, and what's really cool is you can see farther into this trend, the cloud does predict some significant support areas. Price may come down to even touch enter the cloud, but you'll see time and time again that it really is predicting some support areas in an uptrend and some resistance areas in a downtrend until it breaks the cloud. And the thicker the cloud, the stronger the resistance being predicted, and the thinner, the greater chance the price can break through, like it did here at the beginning of these trends. So you can see pretty good predicted support areas. So let's talk about Elliott Wave. I'm going to combine Elliott Wave with Ichimoku Cloud. So Elliott Wave is super easy, right? All you have to do is memorize these 144 pattern permutations, and you got it, right? You got to know about Millennium and Grand Supercycle and minuets, right? Everybody ready for that? You got it? You know, it's totally ridiculous. This is a typical approach to Elliott Wave, and we can just draw a big X through this, right? This is absolutely ridiculous. Nobody could deal with all this, right? Elliott Wave really is easy. The best book on the market on Elliott Wave techniques is called Elliott Wave Techniques Simplified. It's written by Bennett McDowell, and Bennett is my mentor. Several years ago, I began working with him, and he taught me technical analysis in Elliott Wave. Got to the point he wrote this book about 2 years ago and asked me to contribute to it. He said I was one of his star pupils and really got it, and we have a great relationship ongoing. So this is available on Amazon. It really belongs on every trader's bookshelf, so I highly recommend it. Of course, you know, the author's awesome, and the contributing author is not too bad either. It was a lot of fun. And simplified is the key word here. We're only looking for 3 trade setups, right? So here's Elliott Wave pattern stylized, 5-wave pattern and ABC correction, right? Interesting that Ralph Nelson Elliott developed this back about the same time that Goichi Hisada was working on the Ichimoku Cloud, okay? And all Elliott's saying here is, in observing hundreds and thousands of charts, what we seem to see is that there's a collective investor psychology or crowd psychology that moves from optimism to pessimism in natural sequences or waves. Natural sequences is an important concept because we're going to use Fibonacci tools to measure these waves. And Fibonacci sequences show up all around us in nature. And, you know, the collection of market participants are a complex, semi-natural system. So it's pretty interesting. So after a big impulsive move, we expect to see correction. And after a correction, we expect to see a continuation until that thing ends. So 5 waves is the typical. 1 and 2 can be very, very small, not really tradable. But this big move 3, once it's there, it's unmistakable. You cannot miss it. Once you've seen it and, you know, can't miss it, it's too late to trade it. But after 3, there's almost always, no certainty, there's probability that there's going to be a correction to that. After a correction into a Fibonacci zone, there's very likely to be a continuation, wave 5, another impulsive move. So if we can catch wave 3 coming out of a channel, that's awesome. Those are the biggest profits. Wave 4s, we can trade corrections. They're a little tricky, right? A little tricky. Corrections can become complex and take longer than expected. They don't move like this idealized pattern here. After the correction, we can trade the continuation. That's the highest probability trade. It can be very profitable. Why is it the highest probability? Because you got all this evidence stacked behind you saying this thing is following a known predictable pattern. And if the first 4 steps of the pattern were very predictable and fell into the parameters that we expect, the chance of the 5th one doing the, you know, following along into its place in the pattern, pretty highly probable. Typically don't try and trade the ABC correction. They can be really tricky. So I just go looking for a wave 3, a wave 4, a wave 5 trade, 3 trade setups. Pretty easy. Okay. Here's what it looks like on a chart. Not quite as orderly and clear, but again, I said wave 1 and 2 can be very subtle. All we're looking for, remember Dow Theory, a high, higher low, new high. Trend is beginning. Wave 3 is the biggest move on the page. It's unmistakable, right? After wave 3, we expect a correction. After a big impulsive move, right? Collective optimism. People start taking profit, you know, whatever their reasons are. We see it time and again. After a big impulsive move, there's at least a short-term correction back into a Fibonacci retracement zone, which is 38.2 to 61.8, right? After that's happened, we look for evidence. Oh, and we look for evidence that to begin with a low, lower high, new low. If we get those 3 data points to confirm we have a downtrend, then we look and see, is there enough profit to the target zone to make the trade make sense? In this case, there wouldn't have been, right? It would have confirmed the downtrend about the time it's in the retracement zone, so we wouldn't trade that. No profit left. But after the correction, high, higher low, new high. Confirmation of the continuation, wave 5 beginning, and we use Fibonacci extensions to predict where it's going to go next. That Fibonacci extension zone from 61.8 to 100%. These tools are free. They're available on any legitimate trading platform, the Fibonacci drawing tools. Do the waves still work with the HFTs, Doug is asking? Yes. I mean, HFTs are in the marketplace now, and these tools are working for profit for me and for many, many others right now. So I would say the answer is yes. How do we determine when wave 1 actually begins? Good question. It's the lowest bar, right? You know, wave 3 is a bullish trend, so the beginning of wave 1 is the lowest price bar, the lowest price before that trend began. Wave 1 began there. It's the first move up. Wave 2 is the first move down. Wave 3 is confirmed with a third data point, a high. That's the rule. Just wave 2 can go down to the bottom of wave 1, can't go below it, because then that would be the low, and that'd be where wave 1 starts. Okay. Look here, that's again, we had wave 1, we had wave 2. As it broke the cloud, we had a crossover, Kai-Jun over, or Tenkan over Kai-Jun, and price broke the cloud. We had 3 data points, high, higher low, new high, right? Like that, there's an entry, and that became wave 3. Outstanding. So that's using Elliott Wave and Ichimoku Cloud and a little Dow sprinkled on it for an entry confirmation. We believe coming out of a trend, that's where all trends begin, right? Is either out of a channel or at the end of a previous sequence. So that's where we can catch wave 3. And then wave 5, same thing. Here we go. The correction's over. There, high, higher, low, new high. Wave 5 entry, lots of room to the target zone. We got a nice trade. Then, you know, how do I manage stops? I use the Dow Theory. As price moves in an uptrend, I take my entry. I put my stop at the last previous low after a new high is established. Then as higher highs, higher lows, new highs are put in, I trail my stop up to the previous lows. Why do I use that point? You know, some people use fixed stops. You know, it's going to be, you know, $2 below current price or some fixed percent. I think that's a mistake. I think we should use the reality of current price movement, right? And what are the current support and resistance levels on a chart? And those are defined by Dow Theory, because as long as this uptrend is going to continue, as long as we're putting in new highs and higher lows, that last higher low is the current support area. Now, if the trend's going to change, it's going to take that out, and that's when I want to get out of the trade. I want to stay with the trend for as long as possible. I can't catch the absolute top, but I can tell when the trend has been proven to end, and that's when I want to get out. Because quite often we can go beyond the targets, and a trend can go on and on and on and on, and I want to stay with it. So I don't want to just get out if I hit a target zone, right, or at some arbitrary target level. I want to stay with a trend, because that gives us good, healthy trading statistics. You know, Vince was talking before, and I was violently agreeing with him that we want to keep our losers small and our winners high, right? Some losing trades are absolutely inevitable, and so I have a very specific calculation formula for sizing my trade. It's based on the distance from the entry to the stop, and then 2% of my account. And I'll bring a calculator up here as we look at some trades and show you how that works, right? But if I hit a stop, the most I'm going to lose on a losing trade is 2% of my account, which is a tolerable, manageable amount of loss. But if I win, I want it to be as big as possible, because if my winners are bigger than my losers, I don't have to win, you know, I could be a 50% trader. I could win 50% of my trades. And if my winners are much bigger than my losers, I'm wildly profitable. And I'm going to push that win rate up as high as I can, of course, but it takes the pressure off, right? Every trade doesn't have to win, right? If I got big winners, small losers. So there's my riff on that. So that's a bit of theory. Let's look at some live charts, right? Let me show you two trades. You're going to walk out of here with two trades that I like right now that you can go, your choice, right? Your choice. This is what I'm doing, but here's two trades I like right now that you can go act on should you choose. So the first one, let's look at here. Bring up my platform. Yeah, let's get out of PowerPoint. Let's look at some charts. STX, Seagate. So what do we got here on Seagate? Got to compress the data a little bit. Look at this beautiful, right? This is a beautiful Elliott Wave setup with Ichimoku Cloud confirming it. So I said Elliott Wave super easy, right? You want to spot wave 3? It's the biggest move on the page. It's unmistakable. The price oscillator right here helps confirm it by showing the highest amplitude move on the page. This is wave 3. Boom, huge, huge bearish move. There, it corrected. I said after every impulsive move, almost a lot of the time, high probability, there's going to be a correction. Seagate corrected up. It went a little higher. These two blue lines are the Fibonacci retracement zone. It went a little higher. As long as it stays below 76.4, we're good to go. Okay. So then we look. Okay, it corrected. We look for evidence of the next move down, the continuation of this downtrend. Well, low. Oops, went too high. So that wasn't the beginning. So this is the beginning of the correction. Lower low, lower high, lower low, lower high. We came and spotted this thing. We took an entry at 4106 short, 4106. We're in it right now. And I actually took the entry back here, right? Low, lower, high, right here. And so we went sideways for a week or two. I actually posted this on another website, a trading forum. I got mocked, said, yeah, you're nuts. You're shorting STX. They're a marvelous fundamental company. That's fine. That's fine. They may be, but they got a wonderful technical short setup. So I'm short Seagate, and we're making some nice profit on it. And we're getting ready to move our stop. Remember, if we put in a new low, I'm going to trail my stop down to this previous high here. But there's plenty of room still to get in on Seagate Technologies. Let me show you how I calculate that. Got a little handy calculator here. So for short positions, I put in the entry price. Current price right now is 38.61. My stop price is 43.66. It's this red line. That's how I mark my chart, so I can just come back and look at it at any time, pull the chart up. I know exactly what I got going on. Target price on this is this green line, 2047. Okay. So what this is saying is, oh, percent risk, I want two. Oops. There. Okay, this says, hey, go short 396 shares. It's going to cost you $15,000. So that's not 2% of my account. What it's saying is, if it hits that stop from current entry, if it hits the current stop, you're going to lose $2,000, 2% of your account. Okay, I don't want to lose 2% of my account, but I can tolerate it. I can tolerate it. And it says it's got a reward to risk ratio of 3.59. So if it hits the stop, I'm going to lose $2,000. If it's a winner, I'm going to make about $7,000. Okay, there we go. I'm in. I'm down with that. And you know, this these are simple formulas, and you know, you can adjust the account size, and it'll adjust the shares. The trading stats don't change, but the number of shares, of course, and the cost of the position change. So that's how I figure out my position size on this. MJ wants to know where you can find that calculator. For some reason, we don't have the handout feature enabled here, or I would stick it in as a handout. MJ, just shoot me an email. shoot me an email and I'll email that to you. I'm happy to, and anyone else. And my email is dean@followmetrades. Another option, I'm going to be posting a link and giving you an invitation, free guest pass to come to my trading room. So you can come in there in the morning and I'll give it to you there. But shoot me an email, dean@followmetrades.com. I'll give you a copy of that spreadsheet. All right. And again, at the end, I'm going to give everybody who's attending a free guest pass if you'd like to come sit in my trading room the rest of the week. So AMAT, so this is a good time. Robert's asking to take a look at applied materials. If you got some symbols you'd like me to look at, this is the time. Let's do it. I'll offer my opinion, and you can decide if you find value in that. Applied materials. Look at this. What a beautiful trend. What a beautiful trend up. And we could have caught this off the bottom, high or low, new high. We could have got in and rode this thing all the way up. Robert, why weren't you at a webinar that I was presenting at April of last year? Because I would have taken that trade. I didn't have my eye on AMAT. So anyway, way too late to get long on applied materials. But look what's happening here. This trend's about to end, it looks like. We got 2 data points, low, lower high. If we get a new low down here below this low, this thing could be correcting down to Fibonacci retracement zone, down to this region, 35.25 to 27.55 between these 2 lines. By the time it crosses here, there might be some profit left in a short on applied material. Now, it could go make new highs and we'll have to adjust this. But again, way too late for me to go long on applied materials. I like this initial setup for a short. And again, if it puts in a new low here, I would definitely be going short applied materials. So thanks, Robert, for bringing that chart up. I'll show you a long that I like right now. I showed you Seagate that I like as a short. Here's a long that I'm in. This is Vale. It's a mining company. My Iron and Other Stuff, Brazilian mining company. I think trades at serious volume, 13 million shares already today. Here's our pattern, right? Big impulsive move up. There's wave 3. Correction right into the Fibonacci retracement zone. Looking for wave 5 to carry us up into the Fibonacci extension area, 61.8 to 100%, which is above 1223 to 15.23. So we took an entry on this at 903. Current stops at 853. Now you could still get long, and people always ask me, well, is there still time to get into the trade? The easy way to calculate that is let it be based on risk to reward. Again, you always want your wins to be bigger than your losers, and the way you get that is through potential profit. So current price 944, stop price 8.53, target 1227. Still got 3.11 to 1 reward to risk ratio on this trade, so that's definitely still a go for me. So a new position, if I weren't in it now, I'd get in it now. Of course, whether you do or not, it's your choice. You assume the risk for it. Any trade can fail. All trading involves risk. It's funny, Therese says, I was looking at Vale, you typed it in. Great minds and all that, right? So that's a trade I'm in. So any other trades people are interested in? I'm definitely happy to take a look. Just type it into the questions box there, and I'll bring it up and offer my opinion. Another thing we can do using the Ichimoku tools is we can use it to scan. We can use it to scan for good trades. So what I do here is I loaded the Nasdaq 100. Nasdaq 100 onto radar screen here with TradeStation. All legitimate platforms have some table like this where you can load indicators and get the numeric values. So I loaded the Nasdaq 100. I was kind of interested in seeing about some shorts, right? This thing's been extended into a run for quite some time. Just wondering if there might be some stocks that are starting to correct. So you can see I put the symbol list here, 100 of the Nasdaq 100, Nasdaq biggest 100. I got all my values for Ichimoku Cloud here, all the numeric values for Tenkan Kaijin, span A, span B, and then trend direction. So trend direction means Tenkan above Kaijin, that's up, and then a measurement of whether it's above the cloud or below the cloud. So that's pretty good. What I can do then is grab all this data, just do a, just copy it like that, throw it on a spreadsheet where I got some really nice sorting and filtering tools. That's not it. Here it is. Put it on a spreadsheet, and look at that, Yahoo data request failed. Do you think so? The website soon to be known as Oath. Okay, so here's all this data, and then I can add some logic, because I'm going to say, hey, if prices, trend direction's down and prices below the cloud, that's bearish. And if trend direction's up and prices above the cloud, that's bullish. And then I can measure how close price is to the edge of the cloud, because I want to get it to be small. I want it just to have broken out. So I see some symbols coming in. I will look those up in a minute. Let me just finish this thought here. So what I can do now is I can sort this list and go, remember I said I have a thesis that maybe I would like to be looking at some short trades and on the Nasdaq 100. So I can go, I want to look at bearish signals, and I want them as close as possible to the edge of the cloud. So let's do this. There. This gives me, out of the Nasdaq 100, a set of 20 to go analyze here. Well, that's a lot easier than looking at 100, and I've got them prioritized. And what I can do is go really, really fast. I teach a master traders course, and part of what we talk about is scanning, and I teach that we should be able to determine whether a chart has the potential, whether we should even spend time looking at it, in about 1 to 2 seconds. When we bring a chart up, within 1 to 2 seconds, people who have graduated my course can determine whether it's even worth spending time on. So let's run through these, right? Because we can look at, it takes about 10 charts. You have to look at about 10 to find one good winner, but we can do it in seconds. So let's just go, VIAB. And I'll probably go a little slower because I'm going to explain why I'm like or don't like it. VIAB. Seriously? VIAB. It'll take me longer to get the symbol up than it will to analyze it. VIAB. So we were looking for a short trade. This is already in a downtrend for a long time. So no, WBA. That is a messy, chaotic chart. I wouldn't touch that with a 10-foot pole. ILMN. ILMN. That too is pretty messy, and it already had a down move. It's correcting. Maybe the next move coming, but it's a little too volatile and chaotic for me. Here's Intel, INTC. I used to work for Intel for 14 years, and what a great company. I learned so much. Smart people, a lot of integrity, and I worked there through the dot-com boom, had employee stock options and stuff, and that's a big part of why I'm able to make my living this way today. But they don't have a very good chart right now. It is heading down. It broke out of this channel. There is a bit of a short trade, but it's not the best setup for me at this time. So CMCSA. So this is Comcast. Obviously, I've looked at this before. I got some markups. Here's exactly what I'm looking for. Here's a pattern. There's wave 3. Big, impulsive move up, impossible to miss. Early signs of a correction beginning. We had a low, lower high, new low, lower high. We get one more low. I'm going to like this trade for a short into this Fibonacci correction zone. So that looks pretty good. That looks real good. So it took us 5 charts after doing a quick scan. You know, what we do this for 5 minutes. That's not bad, huh? That's not bad. So, oh, Doug, you're still on STX. Man, hopefully you're the only one. because I've been flying through all kinds of stuff. Everybody else, we should be looking at CMCSA. Don't tell me everybody missed all that. That would totally bum me out. Okay. Martin's telling me everything's fine. Okay. Sorry, Doug, maybe yours is just locked up, so I'm going to keep rocking. Okay, Renee says, yeah, not frozen here. Woo! Okay, a little blood pressure spike there. Let me go catch some of the signals you guys are interested in. I got a few minutes left here. And Teresa wants PRGS with exclamation points and a please. Ask nicely, I'm happy to do it. Progressive software. So this is a pretty choppy chart. A couple of things of note here. So there is an uptrend, pretty volatile uptrend. You do have a high up here, and it's approaching that. It's approaching that and starting to reverse. So I don't really like it. I don't like it for a long. It's been going long too long. I don't like it for a short. It's not ready yet, and it's a little more chaotic than I like to trade. So that's where I stand on progressive. CMG for Gary. Yeah, you can see I've got this marked up. This is a pretty nice short. This is a pretty nice short. We got a target. So there's the impulsive move down. It corrected. It channeled for some time. Now here it's heading down again. Now you want to watch. It's got some potential support here and here, although it's pretty sharp. It's a short setup now. I would just watch those possible support levels. Got a target down below 317, clear down to 181. No safer place on the country to go eat and not worry about getting sick, right? These guys hopefully by now have their act together. Okay, AMD. AMD's been in an amazing uptrend. So we're looking, this is kind of like the other one we looked at where, you know, big impressive run. It's starting to correct, right? So there might be another leg to this correction. Maybe. It's already touched the target zone once, so that one's maybe not quite as clear, right? Maybe not quite as clear. This actually could be a wave 5 now continuing up to here, but it's not getting much momentum. So a little shaky on AMD, but that's where we are. Hertz, HTZ. We're actually long Hertz in my trading room, so I like it, obviously. We got long on Hertz at 1371. I tracked these positions here. We're in 15%, 15.47% profit. So there's, it's getting close to 1-to-1. There's a little bit of room left. We got a target of 25.63. The target zone is between these lines, but for risk to reward, I use the lower edge. I'd be a little conservative in my target predictions, but nice long on Hertz. I wouldn't wait much longer if you're thinking about getting into it. Got 5 minutes left. Tesla. Great company, smart guy, cool cars. We traded this. We took a short on Tesla at 366.03, and we took it down to 321. We took it on a 60-minute chart. And so when it popped back up, we got stopped out. We took our profit. It was really nice. We made, here's the closed trades from my trading room. So we got into Tesla on 628. We got out at 611. At $50,000 account, we made 2,500. So it was pretty good. Year-to-date profit, 18% on closed trades, and we've got a bunch more open. So looks like it's going to keep heading down. It pulled up a little bit. It's up today. It's probably going to end in this zone. Between 308 and 259 after this big massive run up, right? High probability of a good correction down. And I know there's, you know, all kinds of news and analysts, everybody's got an opinion, right? Does fundamental data matter? Do stories matter? Absolutely they matter. right? But what matters more than the information and the stories is how the collective market participants respond to it. I don't really have to go look at their balance sheet. I can just see here about what everybody else thinks about it, right? I don't need to look at radar to tell me if it's raining outside. I just need to go outside and see if water's hitting me on the face. And so that's the reality of this chart. It looks like it's got some more time to go down here. Okay, hey, I'm pushing up against the end. So what I want to do, I do run a live trading room. We take stock and option trades. We're in 1, 2, 3, 4, 5, 6, 7, 8, 9 longs, 3 shorts. We're in nice profit on almost all of them. You know, big wins, small losses. And we just call these trades out and manage them. It's not day trading. We're not trading futures. We're trading stocks and options. Typical trades from 1 week to a handful of weeks. So if that's interesting to you, I do have free guest pass. You're welcome to come sit in with us the rest of the week. That runs from 6:15 a.m. to 7:45 a.m. Pacific time, and that's 9:15 to 10:45 a.m. Eastern time. We're there just before the open. We go an hour and a half Monday through Thursday. We analyze the futures charts. So they draw our attention to particular sectors and what's going on. So we watch the futures, we watch the news, but we identify stock option trades and we take them both short-term, long-term, but not intraday. Okay, so free guest pass. Rest of this week, there's a link there. If you watch the recording or you miss the link or whatever, again, send me an email and I'll fix you up. That's a big link to turn copy. Dean at followmetrades.com. Love to have you come join us and see if it's a good fit for you.